We are being joined by Shibani Sircar, who is the Senior Executive Vice President and Fund Manager, Head Equities at Kotak Mahindra Asset Management, as well as Kunal Botra is here on the show as well. A very good afternoon to both of you, and thank you so much for your time. Shibani, firstly, help us with your take on the markets, because some of them are really calling out a near-term bottom in place and also trying to look out for some more opportunities. Give us your understanding on the markets, the bit of a rebound that we are seeing today. What's been your reading?
Hi, good afternoon. So when you look at our markets and the way the market volatility has been since the month of December of last year, the volatility has been on the back of global as well as domestic factors, and some of these uncertainties still remain. However, what we must also understand is that when we look at markets, the Nifty itself has corrected almost 13-14% from its highs. Similarly, the mid cap and small cap indices have seen a greater correction. More importantly, at a stock level, the correction has been even steeper than what the headline indices seem to suggest. So in this context, when we look at valuations today, what we believe is that Nifty, especially in terms of the large cap composition, is trading at multiples which are today lower than its long-term averages. Also, remember, when the Nifty is concerned, we've seen significant changes in the constitution of the index, with a number of private sector companies replacing public sector ones, as well as B2C companies replacing some of the B2B ones, where typically valuations are higher. And therefore, in that context, when we look at the large cap Nifty, the Nifty valuations are reasonable and trading below long-term average multiples. Mid and small caps have seen correction. However, there the multiples are still at a premium to their long-term averages. And therefore, in terms of risk reward, what we believe is that large caps are clearly better placed even after this fall of mid and small caps. And the preference would remain for large caps. Now, in terms of mid and small caps, as I was mentioning, if you look at it on a stock specific basis, some of the stocks have clearly corrected far more than what the headline number in terms of the index valuations show today. And therefore, one has to be more bottom up. Here, there are key factors that we are keeping in mind. One, of course, the business model and earnings trajectory and visibility of earnings. Second is valuations and reasonable valuations, and therefore not chasing momentum, but clearly looking at reasonable valuations. And thirdly, looking at stocks where there is free float and liquidity as compared to stocks where free float is limited. So therefore, from a market construct perspective, some of the uncertainties clearly remain. But where large caps are concerned, valuations seem to be far more reasonable, especially in line with their long-term average multiples.
Thanks for the view coming in. This is Snehi also joining in the conversation. Shibani, until yesterday, we had registered the 10th consecutive day of loss coming in for the Nifty, the largest ever streak or the longest ever streak since its inception years ago. So that seems to have reversed only today in today's trading session. Do you believe that after these 10 consecutive sessions of cuts, we have bottomed out and now the road ahead is optimistic? Or do you believe that today is a one-off that we're seeing in the market after so much back-to-back pessimism and the market correction can still continue going ahead?
So it's very difficult to always call the bottom in the market. So that's something that I would not attempt to do. So what I was mentioning is that when you look at the market correction and look at the reasons behind the market correction, some of the factors have been global, including what's happening in terms of global tariff-related policy measures, monetary policy growth, etc. And there have been a slew of domestic factors as well, including slowdown in terms of our corporate earnings that we saw in the last few quarters, as well as government spending. Now, if you look at these factors, on the corporate earnings perspective, we do believe that corporate earnings should start to gradually improve, especially as we go into FY26. And therefore, that is one factor that we will keep a watch out for. In terms of global factors, including geopolitical tension, tariff-related policy measures, these uncertainties remain. And therefore, one could possibly still expect some degree of volatility in the market. Having said that, as I was mentioning earlier, when you look at markets and you look at valuations, especially where large caps are concerned, today the Nifty is trading at multiples which are lower than their long-term averages. If you look at even terms of the ratio of MSCI EM to S&P 500, given the fact that we've seen a lot of FII outflows out of EM, including India, the ratio is possibly at its lowest that we've seen since March of 99. So it's a fairly long-term data point that we are looking at. And also in terms of stocks, there are considerable number of stocks that are trading almost 50% lower than the 52-week high. So therefore, there is some degree of valuation comfort that is coming in. Now, in this sort of a market, the way we are approaching it is look at stocks where you are seeing earnings visibility. As I mentioned, large caps still continue to offer better risk reward as compared to mid and small caps as a pack. However, within mid and small caps, there are definite points of opportunity. And we would use these sort of corrections to look at these particular segments and stocks in terms of allocation.
That's the take on the markets. Kunal, help us with your take as well. The bit of a rebound that we are seeing today. Do you believe that this is sustainable, or traders might actually look at some opportunity to exit some of those trades where they feel they are stuck and there could be some profit booking from these levels? What is your thinking?
No, I think my sense is, or my two bits is that I would probably believe that this leg of the market recovery which is showing is not a rally which is out of exception. It is a rally which was bound to happen because of the steep oversold nature of indicators. We were discussing this couple of days back also that how 22,000 mark should act as a major pivot point for the indices, and the index should just about fluctuate into a trading band with pivot at 22,000 mark. And I think it's good that we're seeing a bounce back over the last 2 days specifically. What we're seeing also is mid caps, large caps, small caps making a very strong comeback. Now, I strongly believe that from here on we should be looking at two very important level of resistances, because both these resistances are actually the gaps which were created for the index. The first one is at 22,500 mark, which was I think a gap created just about 3 or 4 trading sessions back. And then the second one is around 22,800 mark. So these are the two resistances which I would probably keep an eye on. But the very interesting part when I'm looking at the charts of individual stocks, many of the stocks have come back to their February first week levels for themselves. Whether it's like, for example, SBI, whether it's the mid cap names which are beaten down 20-30% in the month of February, many of the stocks are coming back to their February first week levels. So even if you try and put this as a context that how much the markets can bounce back, then we could be looking at the Nifty coming back towards the February first week lows. That itself should be almost 23,800 plus, 22,800 plus mark for the index. So net expecting the markets to continue to move up higher, 22,800 could be the first formidable resistance which we can keep an eye on.
We are currently holding on to the gains that we've seen over the course of the day, around the 22,300 mark, comfortably above that for the time being. And it's looking good for the broader end of markets today as well. But there is one stock, in fact, a couple of stocks that are beaten down in today's trade belonging to the NBFC side. And Bajaj Finance is one of those, a 3% cut on the stock as we speak. But let's understand why this is happening. And from media reports, we understand that the RBI has directed large NBFCs to stop new lines of credits and renewals. Let's understand what this means first of all and what the impact could be on these NBFC companies. Shweta Daptardar, the Vice President Lead Analyst of Diversified Financials at Elara Capital, is joining us on the phone line for the same. Shweta, first of all, good afternoon and thanks so much for joining us. Give us your first take on how do you see these restrictions from the RBI directing NBFCs to stop new lines of credit and renewals. What impact do you think this could have on the NBFC players right now?
Yes, good afternoon. So you have absolutely pointed out correctly that the renewals of these flexible lines of credit, which are generally provided to small business owners, have been directed by RBI to curb as far as large NBFCs are concerned. So we incidentally have to understand the fact that the RBI's concerns stems from the fact that these are not fixed repayment structured loans. So the borrower might take the part of the loans or use these cash flows from the loans to siphon off the funds and use for multiple other purposes rather than paying off the existing loans. So this concern is largely coming from there, wherein these loans have also lagged impact because of the flexible nature and structure of the loan. So largely, this is slightly detrimental for NBFCs who have been engaging in giving SME loans, small business loans. So while we at Elara Capital have not interacted directly with the NBFC management, but prima facie we understand players like Poonawalla FinCorp, Bajaj Finance, AB Capital, L&T Finance, IFL Finance have been giving small business loans or SME loans. So yes, we definitely wait and figure out as to how this will pan out for each of the players. But as of now, this definitely would mean slightly detrimental to the incremental disbursals.
Hi Shweta, good afternoon. This is Shrishti also joining in. So we do understand that you have highlighted some of the stocks there and some of the names which can get impacted if this goes through. But give us a sense that what is your estimate of the total credit disbursed under this particular facility in the overall pie? How much share this particular facility might have, and what could be the likely impact on the sector as a whole?
Yeah, true. So like said, one such data point is not present or available, but media reports have been highlighting that such a line of credit could be in the quantum of as high as 50,000 to 60,000 odd crores as far as NBFC lending to such small business owners is concerned. See, we have to understand the fact that RBI has been constantly highlighting on the indebtedness or the over-leveraged scenario that has unfolded at the borrower or the customer level. So while this particular payment structure or these particular flexible credit lines allow the flexibility to the borrowers for making the principal payments at the end of the tenure of the loans and make only interest payments in the initial phase of the loan period. So this would definitely mask the actual credit worthiness of the borrower. So that is something RBI is primarily concerned about.
Lastly, before we let you go, help us understand if this could lead to some liquidity issues in the system, and if it's not going to be the NBFCs who are going to be looking behind this renewal and the extension of this credit line. Do you think banks could be emerging winners now? Because this restriction we've not heard on banks so far, it's only been on NBFCs, right?
A better position to extend such flexible credit lines because they have strong hold on the cash flow assessment of the borrowers. NBFCs, on the other hand, do not have direct access to the overall situation or scenario on the cash flows of the borrowers. So I think banks definitely are your slighter beneficiaries. Coming back to NBFCs, as I mentioned, we do not know the exact quantum of this particular credit line. So we really do not know whether that this will have a contagion effect in terms of liquidity stress. But yeah, nonetheless, both the individual borrowers as well as the business owners will definitely find difficult to raise incremental funds in the interim periods.
Shweta, with this, we'll let you go, and that really appreciate you taking the time out and giving some more sense on this particular news flow. But definitely on the back of this, the media reports highlighting some restrictions there. Bajaj Finance is one of the top losers. But with this, let's get back to our techies then, and Kunal as well as Naresh are both on the show right now with us. And Naresh, I want to come to you for have some of the stocks that you are eyeing at this point in time. Give us your closing trade picks right now.
So we are seeing a good bounce in the small cap index. So looking at a stock which has done well in terms of not correcting, that is a brand Industars. The stock has not broken below that 315, 320 mark for the last 3 months, wherein majority of the market stocks have. So looks like a eventual move towards 360, 370 again also going forward. So for now, a good risk reward buy in the stock.
Okay, and Kunal, what about you? What's looking good right now? What would be your closing trade recommendation?
Yeah, I'll go with a differentiated contra buying call. It's a buy on IRCTC. The stock, over the very short term, looks to be have hit the major oversold territory in terms of indicators. So I think at current levels, would look out for a swing upside of at least 5% over the very short to medium term.
All right, with this, we'll slip into a very short break. Viewers, don't go anywhere. We'll be right back with more, but just on the other side of the break.